45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Welcome everybody, welcome tonight. Before we get started, my name is Cameron Carlson. I'll be presenting alongside Reed Hazard. Can you let us know if you can hear us all right? If you can hear and see the screen, just type in the chat real quick, say yep, yes, we got it. Feel free to just let us know if you can hear us all right. Okay. Well, thank you everybody for coming tonight. Very excited to present one of our more popular topics lately. We're going to be talking about some of our exclusive 4.25 to 5.25 interest rates and how that works, the financing programs, and Reed Hazard's a wealth of knowledge, so he'll be diving into that a little more tonight. And for some of you, I know that this might be your first time with us, and so we'll talk a little bit about what Marshall Reddick is and a little bit about myself. So I'm a real estate agent here in Orange County, as well as an advisor, and I've been with Marshall Reddick a little over 3 years now. I graduated from Vanguard University with my bachelor's in business admin. I bought a house here in Orange County, and I currently invest in the Marshall Reddick Mortgage Fund, and I'll give a brief overview of what that is. I've also done real estate transactions in 7 different states, and I also work with owners looking to find property management, and so I've helped 120 owners last year find property management here at Marshall Reddick. So maybe you've heard about us, maybe this is your very, very first time, and a little bit to explain what Marshall Reddick is. We're a one-stop shop for real estate, and we can be broken up into 4 different divisions. The first is we are a real estate brokerage. So we've helped people buy and sell their primary residence as well as investment properties nationwide, and we did about 600 transactions last year, and 90% of those investment transactions we also manage, which brings us to our second division, which is property management. We take care of absolutely everything for you as a landlord, whether that be leasing, maintenance, renovations, rent collections, and obviously pretty much everything in between. And all you need to do as a landlord is collect a rent check. And then third is we actually have private lending here at Marshall Reddick. So sometimes you might not be able to qualify for conventional financing, which is a lot of what we're talking about tonight, and you might need private financing. Well, Marshall Reddick provides non-owner occupied real estate loans to borrowers that are maybe doing fix and flips, new construction, or just purchasing investment property. And then the fourth division, as I mentioned, myself and Reed both have good positions here in the mortgage fund. The same way you can own real estate and collect a rent check, you as an investor can also own a mortgage and collect mortgage payments. So the mortgage fund is a pool of capital where you basically just collect quarterly distributions on the mortgage payments that are made from the mortgages that we invest in. And then within all of this, I'm an advisor, and I can kind of take you in any direction that you're looking to go and answer any questions. So when it comes to choosing a market, why do we choose our markets, right? Well, first, let's take a look at where we are. Marshall Reddick is in California. You'll see we have offices in Los Angeles, Orange County, Riverside. Marshall Reddick's also in Texas, where we have an office in Austin, New Braunfels, San Antonio, and Houston, as well as Tennessee, where we're in Clarksville and Nashville, and then we're in Cape Coral, Florida. Aside from California, all of our other offices are where we're going to be finding some of these 4.25, 5.25 interest rate promotions and deals. Here's a picture of our team, top left with the big, huge sign. That's our New Braunfels team. And then the top right is going to be our San Antonio team. On the bottom right will be Clarksville, Tennessee. And then in the center there, that's our Newport team. You'll see Reed Hazard there too, always a part of our photo. And bottom left is our Cape Coral team. So how do we choose a market? Well, there's some categories that we always go over when deciding which market that we're going to place our offices and we're going to plant our roots in. First is there a stable job market there? We want to make sure that there's a low unemployment rate and there's a good opportunity for workers in the workforce there. Second is vacancy rate. Is there a low ratio of homeowners to tenants? We want to make sure it's pretty even, so there's a good amount of renters that are looking to rent your property. And similarly, how fast can you rent properties? Also, we want economic diversity. We don't want to be in a market where there's just one or two strong markets there, and if it falls apart, the whole economy falls apart. So we're looking for government jobs, we're looking for maybe military, medical, IT, a spread of all industries in the same area to help make for a stronger market. And then next is an affordable market. Is it a low barrier of entry? It might be harder to get a property to cash flow when the barrier of entry is $1 million versus the median home price of some of the homes we'll see today are closer to $300,000. Next, is it landlord friendly? I know for Texas, Tennessee, and Florida, they're very landlord friendly markets, and you as the landlord have a lot more power and control, and it helps you when you get in a pickle with potential situations with tenants. Also, is there a good education system? Maybe there's a university in the market, maybe the suburbs have high class school districts, and that's usually where we want to target. And then last, is there reliable property management? The last thing you want to do is be in a place where there's one or two property managers, and if one of them's not very good, well, your options are limited. All of the markets that we operate in, you'll find that there's a lot of property managers in the same market, meaning that we have to be competitive and you have to see a high quality of service in order to make sure that that property manager retains their business. And so a little bit about our property management. We believe that we should only profit when you as a landlord profits. And what I mean by that is we charge a percentage of the rent collected, and we don't charge when your property is vacant. Similarly is we think that we should only profit when you profit, so we also don't charge for maintenance. A big conflict of interest you'll find is if there's a property manager that does their own in-house maintenance, they're likely tacking 5, 10, 15% onto every maintenance charge. For us, we just outsource it. And then you'll see that we have a leasing fee, which is 50% of 1 month's rent. If the tenants are late, we give that to you as the landlord. We give half of that to you, and we take half of it for doing the work to collect the late fee. And last is obviously we want to make sure we're aggressive with our renewals. So every year we're going to run you a market analysis report and let you know, hey, this is how much we can increase your rent, and making sure that you are at the top of the market, which is extremely important. So now I will hand it on over to Reed Hazard. Reed is our preferred lender of about 20 years now. He does about 90% of the mortgages, all of the investments we sell. He's even done a mortgage for me myself, so I can say from personal experience, it's great working with Reed.
Awesome. Thanks for having me tonight, you guys. How's everybody doing? Hope you're doing well. Here tonight to talk about the special financing, and super excited to be here. So a little bit about myself. I started doing this in 2005. Bought my first property when I was 19. I've purchased and sold several properties since then. I currently have 7 properties. I definitely eat my own dog food. I'm invested in some of these same markets that we're talking about tonight. So always excited to be on this call, and also to chip in from more of a personal standpoint, being an investor with Marshall Reddick and just knowing a lot about how their systems work. Anybody wants to hop on a call anytime just to talk about what it's like to be a landlord with Marshall Reddick, how the property management works. Always available to give you guys a view on that side of things as a client. And then obviously as the preferred lender, I have an extensive background in mortgage finance. And one of the products we're here to talk about tonight, I'm very excited about. It's the forward commitment. So we're going to dive into that here in just a moment. Some of the info I'm going to be covering is what is a rate buy down? Like, what is a loan discount point? Many of you guys know, but I'm just going to break it down I'm going to go over current conventional guidelines for max seller credit. So how much can a seller buy down your interest rate? And then how do we get around, the seller only being able to credit a certain amount? How do we get around that to buy down the rates even more? And that segues us into what is a forward commitment. We're going to talk about the new construction inventory that we have throughout Marshall Reddick that currently has interest rates of 4.25 to 5.25%. One of the properties, we have a few of them left that to sell them as fast as possible, they're actually giving a 3.99% rate. So we'll discuss that. And then we're going to go into a little bit about the buyer paid closing costs. What are you charged when you do a commitment loan, and what does that look like? We'll also talk about how to apply. So what is a rate buy down? How do loan discount points work? For example, a $500,000 purchase price with 30% down is a $350,000 loan amount. Paying one loan discount point would be equal to paying 1% of your loan amount. So you'd pay the standard closing costs that you would pay for a transaction. You'd pay some title fees, some escrow fees, an appraisal. You'd have some prepaid costs like paying the first year of your homeowner's insurance at closing. You'd have some processing and underwriting fees that are charged by the bank. We are the bank, by the way. We're not a broker. We're the ones lending our own money. We also service our loans. But so there's always going to be lender fees for processing and underwriting. And then a loan discount point would be an added fee on top of that. So 1 point equal to 1% of the loan amount. When are loan discount points charged? When you select a mortgage rate that is below the market rate. What other factors affect your interest rate? So let's say that the market interest rate today for a primary residence is 6.375%. That's the market rate that there would be no loan discount points. Well, if you're buying the property as an investment property, there's going to be a pricing hit for that. There's going to be points that are actually charged by Fannie Mae and Freddie Mac, because these are all conventional loans. They have no prepayment penalty. And they're essentially bundled and packaged after they're funded, and they're sold sometimes directly to Fannie Mae and Freddie Mac, or they're sold to large institutions. Hedge funds buy this type of debt. Foreign central banks buy this type of debt. Why? A Fannie Mae mortgage-backed security might be paying 5 or 6% return, and that bundle of mortgages that investor buys are backed by U.S. real estate and also backed by a fully underwritten loan. The buyer's income, the buyer's assets, the buyer's credit. You have to meet these certain guidelines with debt to income ratio that show that the buyer's ability to repay is very strong. And all of that equals into they have a low default ratio. If a big institutional hedge fund is going to buy, they have $1 billion to spend. They might buy $500 million worth of the S&P 500, right? Buy some stock indexes. But then they're also going to buy some bonds in there. They might buy some T-bills, which is the U.S. needing a loan and where we buy their debt. A U.S. 10-year T-bill might pay 4%. So they'll buy $300 billion worth of T-bills. And then they may buy $200 billion worth of mortgage-backed securities because it has a low default ratio and it pays a higher rate of return than a T-note does. So again, these types of loans are underwritten. They're just very, very safe mortgage-backed securities because of the type of loans. And so if it's an investment property that you're doing, there's going to be a pricing hit charged by Fannie Mae. If you go with the minimum down payment for a 2 to 4 unit property buying as an investment, you got to put 25% down as a minimum. There's a pricing hit for it being an investment property and going with the minimum down payment. If your credit scores are lower, if you have a 720 FICO score instead of a 780, there's going to be a difference in pricing. So those different factors will actually generate points. And that's why when you look at what is a market rate for an investment property with no points, it's going to be much higher. It might be a 7.25%. Because if we're not going to charge you those loan level price adjustments, the market rate is going to be higher. So these are the different factors. You're buying a primary residence and the market rate is 6 3/8. You can pay some discount points to get a rate that's below the market. Or included in that is the type of the reason you're buying. If it's an investment property, the amount of down payment, the FICO scores, all of those can also generate points costs, or you can take a higher interest rate. So how much can a seller contribute towards buying down your interest rate? Well, for a primary residence, if you're putting 10% down on a conventional loan, they can contribute 3% of the sales price. If you're putting more than 10% down, they can contribute 6%. If you're putting 25% down as a primary residence or more down, they can actually contribute up to 9%. But when you're buying a property as an investment property, the max a seller can contribute is capped. It's capped at 2% of the sales price. So for example, if it's a $500,000 property, the max a seller can credit you is 2% of the sales price. They'd be able to give you $10,000 towards rate buy down. They would not be able to give you either any other types of closing cost credits. That's the max they can give you. So it's not just how much are they giving you towards rate buy down. It's really how much can they give you towards everything. The max is capped at 2% of the sales price. So let's look at rates today. I actually priced out a rate sheet on the next slide to go, well, how much would $10,000 do for me if I wanted to use the max a seller can credit me towards buying down the rate? So at 6.375% would have, give or take, a little bit over $10,000. As the market rates have been improving a lot recently, the lower note rates closer to 5.5 to 6%, the 5.5 coupon, which is anything 5.5 to 6% rates, in anticipation of mortgage rates being lower about 6 months from now, you're starting to see a lot more bond buying in the secondary market for mortgage-backed securities that carry a 5.5 to 6% rate. And as a result, we're seeing the note rates improve quite a bit in that area from where they were at a few weeks ago. The market rate, though, itself has really not come down too much yet. I mean, we haven't even cut the federal fund rate by even 0.25% yet. It's still the federal fund rate, that overnight borrowing rate for banks and institutions that's set by the Fed, is still at 5.25 to 5.5% right now. It's take us back 2.5, 3 years ago, we were at 0, right? So there's a lot of room for that federal fund rate to come down. And why you've seen rates already approve ahead of this rate cut that's more than likely going to happen on the 18th of this month is because the bond market moves in advance. If it knows inflation's coming down and the Fed's going to be cutting rates, money moves in to the bond market about 6 months in advance always. So we've seen that in the bond market the last couple months, and as a result, we've seen bonds appreciating, we've seen rates improving. So again, rates closer to 6% and then rates that are 5.5 to 6, you're seeing those note rates really improve right now. For example, a 6 3/8 you can get where the seller could pay that buy down for you. And if you just paid a little extra points out of pocket, look at this note rate right here over at a 5.875. You could pay about a point extra out of pocket and be at a 5.875, really down to a 4.5. It's still palatable coming out of pocket. But anything 5.5, basically 5 to 5.5, or these note rates down in the 4s, it's going to take a very long time for those to improve dramatically, you guys, because the Fed's going to have cut rates multiple times, and the market rate needs to be closer to those levels, where right now the market rate is still up in the 6s. So over time, though, we can expect rates to come back down pretty dramatically from what we're seeing here in the bond market. And as that happens, as the market rate, not these buy down rates we can do with builders, but the market rates, someone that's not even as educated about what a buy down is, they go into their local bank and they're getting quoted a 5.25 interest rate. Oh, I can afford that payment now. I couldn't afford that payment with 5% down for this primary residence when the rate was 6.5, but it's 5.25 now. Oh, you know what? We're ready to buy. And that's why when the market rates come down, by and large, you'll see demand pick up again more as those rates go down. In the meantime, we're able to still do buy downs like this if you're not buying a new construction property, or if the new construction builder is able to offer 2%, that's what they're able to do. We can still get a really great rate for you right now, as you guys can see. But how do we get into the rates in the low 5s? How do we get into the rates in the 4s where you guys can clearly see? I mean, a 5 1/4 is almost 6 loan discount points. A 4.75 is almost 8 loan discount points. That's more than a buyer would be allowed to pay. You'd violate what's called qualified mortgage guidelines that state you can't pay more than a certain amount of closing costs. You're not allowed to. And those rates require way too much seller credit to be within that 2% max seller credit guideline. So how do we get down into those really low note rates? I'm going to talk about that in a moment. So again, back to my example, the max seller contribution, 2% of sales price, that would limit on a $500K purchase price to $10,000 in max seller credits. That's going to get you something in the lower 6s right now. If you pay some extra points, it'll get you down into the higher 5s. And the typical rate scenario still for an investment property right now, really the average lender out there in the nation is probably still going to be about a 7.5 actually. Rates in the high 6s, no points investment for a multi-unit would require a very large price exception. So yeah, they really haven't improved too much yet. Now, sometimes builders, sellers are willing to credit more than that 2%. How are we able to utilize that concession? A forward commitment. Now, let's say a builder like 210 Communities, for example, that's a very large builder partner with Marshall Reddick, and we've been partners with them for many, many years. We've been involved in many of their different build projects. We trust them. They trust us. Let's say that they tell us, hey, Reed, we're going to get you $5 million worth of loans in the next 12 months. And I say, great. And then they say, okay, we now are going to get you those loans. We're going to commit. And they buy a rate sheet from us. That is a separate transaction than a transaction between the bank and the consumer. It's a company-to-company transaction. And for that reason, the 2% of sales price guideline does not apply on that transaction. So they can buy a rate sheet from our company. And when they buy that rate sheet, usually it's locked for 3 or 6 or even 12 months. So you don't deal with lock extension issues, and you don't deal with a lot of changes during the process with your interest rate or with the loan discount points. It's very clear. You get your loan estimate, it's all organized, and the rate is what it is, and it's locked for the duration of the period. So let's say that they commit to us. They go, we're going to get you $5 million in loans. We do a 6-month interest rate lock, and they decide we're able to pay whatever, $30,000 per deal, whatever that dollar amount is. We have the margin here that we can pay X dollars. We look on the rate sheet. Okay, that'll get us a 4.75%. I now can take that 4.75, and through my company CMG, somebody can apply with me, and I can slot their loan, that $400K loan or $350 loan or whatever that loan amount is. We can slot it into the, for example, the 210 Communities $5 million trade. And that $400,000 goes in there. And as those loans get funded, once the $5 million is funded out, then they pay for the trade, and we can open up another new trade. So by doing this, though, basically we can make a market rate, whatever we want to, that the builder is able to pay for. It could be a 4.25% interest rate, right? Now, along with those points that the builder would pay so that I can go market, oh, we're doing a 4.75 special, right? 4.75% special. Now, when you apply with me, the only thing that will apply is the loan level price adjustments based on how you're buying. Is it an investment property? Are you putting 25 or 30% down? What are your credit scores? And depending on how much money that the builder has to be able to apply towards the transaction, we can do a deal that has no points at all, or you could pay some of your loan level pricing adjustments. But again, what does this commitment allow us to do? It allows us to be able to buy down to market rates that would normally have much too high of a cost for a consumer to be able to buy down themselves or be able to be credited from a seller. So it's just an amazing tool. You're seeing it in a lot of different areas of Texas. You're seeing it in Florida. You're seeing it in Tennessee. A lot of the markets where there's a lot of new construction, is where you're seeing these forward commitments. And so, yeah, for any of you guys that are wondering how the heck were they doing that, this is how we're doing it. And then what we're doing as a company is we're slotting those loans into bond pools, and we're selling them on the secondary market to other institutions and hedge funds. At CMG, we also have our own securities. They're called CMG securities, where we are actually creating these securities, selling them. In some cases, we're actually selling them to companies that we own and holding these loans, because investors have a very low default ratio. They tend to always make their payments, right? If you can afford to buy an investment property, you probably have already been able to buy a primary residence. Either way, you're putting a larger amount down also. There's more protective equity. So this is just a very lucrative way that when you're a large company like us and you have your own securities, that we were able to put this program together. Normally, you have to buy about 50 million at a time. You have to commit. Like Lennar Mortgage, those guys are committing in the secondary market to doing $50 million bundles at a time. We, because we're a large company and have our own securities, we're able to do smaller commitments with smaller builders. And what we love about, they're not small builders, but what we love about these small to mid-sized builders is the quality, the time that they put into their properties. A lot of times the craftsmanship, the location of these properties, right? They're in the best locations. They're in the best school districts, lowest crime rate locations. So we're able to cater to a smaller builder that we as investors prefer. You'll notice a theme about the 2 to 4 unit properties that are sold through Marcia Reddick. They have 3-bedroom and 2-bath on each side. Some have 4-bedroom, 3-bath. They have attached garages on each side. They have separated backyards, right? They're in great school districts. By and large, every property, for the most part, that you see sold through Marcia Reddick will meet that criteria. And again, the smaller to mid-sized builder that's building the more quality properties and the more quality locations, and not building such massive amounts at a time either, right? They might build 100 units and under, somewhere around that. That's where we see the most quality from an investment standpoint. And so we just absolutely love this. We're able to get A-class properties and get them to cash flow very, very nicely through being able to do these forward commitments. So a little bit about why new construction. These are just some thoughts that I had that we always look out for. Now, Cameron is a real estate advisor as well. I mean, that's what he does day in and day out. And I'd love to get your take on this also, Cam, on why are we selling new construction properties? Why do we like new construction being an investor?
Yeah, absolutely. I mean, when you're asking what's the benefit of new construction, well, we have to take a look at, obviously, we still see that we've had inflation with prices in general over the past 2 years. Yeah, it's slowed down a little bit, but with inflation, we haven't seen the price of new construction go up. They haven't been raising their prices similar to inflation. However, what we have seen is they've had more incentives and they've gotten even more aggressive. Builders really, they're in the business of selling properties. They're focused on moving their inventory. So the incentives are basically required to get their properties sold if they're not selling them. And they just have a margin. They have a margin on every property. They dig into that margin, and it's different than when you're just, a random seller, a third-party seller. It might be like personal. Maybe they don't have any capital. They can't offer the same incentive that a builder does because the builder's okay with digging into their margins. And we probably won't see much of a change with their prices until rates come down. Obviously, as Reed mentioned, when rates come down, demand will pick up, and that's when we'll probably see prices start to raise again. But right now, there's just really good options out there. In these new construction properties, there's less maintenance. Obviously, it's a brand new home, and if you do have maintenance items, you have warranties on it. A lot of these warranties are, for the first year, the entire inside of the house is covered in warranty. And then you've got 2 to 3 years for your plumbing, electrical, and then 10 years for your foundation. It's great to have that up front versus if you're buying a home that's 20, 30 years old, you're on your own for every maintenance repair. So you already know that you can probably account for a little less maintenance on these new construction properties. We even reflect those on our pro formas. Second is it's a lot easier to rent a brand new home. Tenants love new homes. They love being the first one in them. They love newer homes in general. It's just, fancy, it's new. And so we're finding that it's very easy to rent these out, So your vacancy is going down. It's cutting into it. It's not as easy to rent an older home that might not be as updated or have the newest finishes. And so your vacancy starts to go up as the age of the home increases. Also there's a ton of variety. These builders, they have a ton of inventory they can make, but they can customize it. They can change it. They can tailor to every investor or different communities or different neighborhoods, whatever it is that they want. And so it's not just like you're stuck to one specific home. There's a lot of inventory, a lot of variety. And then last is, like I mentioned, their incentives are very aggressive. One of those biggest incentives is these forward commitment rate finances. And I'd love, Reed, if you can weigh in on your thoughts on new construction.
Yeah, I mean, I think like when I look at these, the first thing I look at as an investor is the appraisal, because look, it costs a lot of money to obtain these forward commitments, right? So I look at what was the price of this a few years ago? Has it still been going up even though inflation's been going up? No. You haven't seen a lot of price increases. If there were any price increases, they were very, very moderate. We look at the location, obviously. Location is number one throughout Marshall Reddick. Like, that is the most important thing. Bed and bath count, very important also. But I mean, either way, like, we're looking at the location more than anything. And so when we look at these properties being in great locations, when we look at the fact that we've got the forward commitment financing, the first thing I want to see is, what does an appraisal look like? What are the comparable sales? And you guys, when we order an appraisal, these are conventional mortgages. These are backed by Fannie and Freddie. We have to order through a third-party management company. That management company selects a local market appraiser. We can have no contact with them prior to completion of the report. We don't select the appraisers. And these appraisers put their licenses on the line. And so when we get back in those appraisals, I've noticed consistently everything is appraising. And they're not just appraising off of their own properties. They're appraising off of about a 5-mile radius on other comparable properties. And I've yet to see these builders that we work with, values coming in low. The values are coming in right on target. And so again, you're just not seeing, though, the prices increase. When I look at investing, I'm looking at holding for 10 to 15 years. I don't think properties are going to appreciate dramatically in the next 24 months. I just don't. I think you could see values start to rise again. I think rents are going to start rebounding more, definitely. But the next couple years, if you need to deploy capital, it's a great time to buy. You can get great positive cash flow and be in these great locations in the path of growth. Some of these areas we're going to share tonight, you are right in the middle of the growth, and you're getting a great return even based off of today's dollars. I just think more, you're looking 3, 4, 5, 6, 7, 8, 9, 10 years from now. I think there's a lot of appreciation potential, and I think that you're getting great positive cash flow because of these builder commitments, and it's not built into the price. If you did look at, well, they're only going to do these if we raise the price 30 grand. If you look at raising a price on, so let's just say that was the case. If you raise the price on something that was going to be $550 with a 6.5 rate, or it was going to be $600 with a 4.25 rate, you're going to have way better cash flow on the property that's $600 with the 4.25 rate. The fact is, you're buying the property at $550. You're buying it for what it's worth, but you're getting the benefit of having that lower interest rate. And we run these numbers constantly on the Marshall Reddick calculator on the website. Any of you guys that are not using that, just Google Marshall Reddick property calculator, and you can see like how intricate that it is. When we're running these numbers on the Marshall Reddick calculator, interest rate makes a lot bigger difference to payment than purchase price. Again, I just love that we're not overpaying for these properties. You're paying the current market appraised value. And because the 2% sales price credit is just not enough to get good positive cash flow, the builders have really stepped up to, pay for these large rate buy downs like this to give us as investors really great positive cash flow on a property that actually is in a location that it has a lot of appreciation potential. When you look at where you make wealth investing, positive cash flow is the glue that holds it together. It's what covers your carrying costs every month. And then when you have a vacancy, that mortgage payment is being made with some of the cash flow that got built up. When you have an expense, that expense is getting paid for out of the property account through some of the cash flow that you built up. But over the long term, where you build the wealth is when the principal through the principal buy down. Every month the mortgage payment's made, that mortgage balance is going down. And then in the appreciation of the asset, right? And that has so much to do with the location. So we're going to get into the actual properties themselves. And before I do that, just real quick, a little bit about why CMG, just fast turn times, licensed in all 50 states, 10th largest bank in the nation. But one thing why I wanted to slow this slide is because of the rate rebound program. So we do cover your cost to refinance, all of your lender fees, $1,000 of your title and escrow, and the cost of the appraisal to refinance anytime in the next 5 years after closing. So if we're doing one of these commitment loans at 4.25%, you really don't need to refinance that loan. I mean, for rates to come back down that low on an investment property, multi-unit, it's going to take a very long time, if ever, because that really means that a primary home rate's going to have to be back in like, you know, the mid to higher threes. It's possible that can happen, but that's pretty much a far-fetched dream. I do think rates will come back into the fours. But again, depending on the commitment loan that you're doing, it might not make sense to ever refinance it. But this is something that we do offer. So any loan, though, that you do with us, we will cover most of your fees to refinance anytime in the next 5 years. And then getting pre-approved, we're you know, go to my website, reedhazard.com. We'll send all the documents needed. My production managers, Mike and Brian, will collect your documents and we'll get you pre-approved. And then we provide the loan estimate based on the property that you're looking to purchase. This approval is good for 120 days. So we do run the credit one time. And if you're just deciding if you want to put together a game plan, but you're not ready to move forward with getting pre-approved, we can have a pre-qual conversation. We can do soft credit pulls. You know, this is definitely not something that everybody wants to jump into overnight. And so mortgage planning is a big part of this. But anyone that wants to get approved and wants to buy now or is ready to go out and start shopping, we would just follow these steps. And the process to get approved takes about 24 hours. Okay, so we're going to cover some of the featured properties now. Cameron, I'll let you get started, and then I'm going to just kind of chime in with some thoughts as we go. Cameron? Looks like Cameron's mic might not be working. So I'll jump in and talk about these because I love each one of these properties. These are the Buda duplexes that we have. These are offered through 210 Communities. These are just fantastic, you guys. These were really, really built nice. And the rents that we're commanding on these right now, the vacancy factor is very, very good. I talk to property management quite often, and these are renting within 30 days. And there's 3 different models. You have a 619-500 model, you have a 634-500 model, and then the 649-500 model is the largest model. They have, in this current phase, I think we have 3 or 4 left that they're doing a special on right now, that if the buyer pays 1.7% of the loan amount with 30% down, they'll do a 3.99% interest rate. Or you can do 4.25 with no points. And that's only on a couple of the ones that they have left. Most of the others are a 4.75% interest rate with you paying your loan level pricing adjustments. And just to talk through the numbers, this is the way to get an A-class property, and your monthly cash flow is $732 a month. With 25% down, this property cash flow is about $500 a month. We were selling these at a 5.25 interest rate, and we were doing just fine. But the builder wanted to sell them faster. I think we sold 9 in a month at a 5.25 rate. And we dropped it down and we did a special over the summer, and we sold 17 properties in 1 month. So the builder was very excited about that. The incentives that they're doing on these are just phenomenal. And Buda is an area of Austin that is just exploding right now. Any of you that know the Austin market, it's a little similar to California. So I own property in Austin as well. I own a single family home in Bee Cave, really, really nice area of Austin, Texas. And what you notice in Austin is the income is a lot higher in Austin. People can afford to buy their own homes versus rent. And so you do see a lot more home buyers in the market than other areas of Texas. And so for that reason, you've always tended to get higher appreciation. It's also more rate sensitive in Austin. And I think as interest rates come down over time, you're really going to see the demand pick up a lot in Austin. So this is a great opportunity to get an Austin multi-unit in a thriving area of Austin that is really set to appreciate a lot over the next 10 years. But you're getting an interest rate that gives you phenomenal positive cash flow based off of today's rates. So I absolutely love these. This is actually a builder that the developer is 210 Communities, and then the builder is Sri Biram, builds amazing properties. These are very similar to the 210 Communities properties that I just showed you. This actual property, I own a single family home right around the corner from here, so I know this area well. This is very close to Helotes, which is the northwest area of San Antonio. I actually have a property 10339 Lupine Canyon that's in Helotes, so I know this market very well. These are actually located right next to one of the best high schools and the best middle schools in San Antonio. The Olympic swimming team actually trains at that Northside Swim Center. It's just, these are in a phenomenal location. I think over time too, the rents in this particular area, I really see them growing a lot over the next probably 2 to 3 years, just because this area is so desirable, but there's not a lot of duplexes. And so we haven't seen that the rents are too high on these. And so the builder's doing a 4.75 to a 5.25 option on these. You will get some positive cash flow. These are a little bit more of an appreciation play. Again, the builder does have the ability, and they're doing a buy down for us so we can get some positive cash flow. But these, I think, have a little bit more of an appreciation play to them. So yeah, anyways, and we can go over a little bit more about the financials on these. This is a new product that we've been selling here more recently that, again, we just think is phenomenal. And it's located in that northwest San Antonio market. This is also in the northwest San Antonio market. These are 4-unit properties. These are phenomenal. These cash flow very nicely. And the builder is actually doing these at $995 purchase price with a 4.25 interest rate with no points. I think they have 2 or 3 of these left right now, and then they're going to be gone. So, and these have very good cash flow, really just because of the interest rate that the builder is providing. So these are single family homes in Tennessee. Anybody that doesn't know a lot about the Tennessee market, it's growing like crazy out there right now. It's been growing now for a long time, but you're seeing a lot of people move from different markets into Tennessee. I actually have some of my closest friends just moved to Nashville. You're seeing just a lot of companies move to Tennessee. This market has a lot of room to go over the next 10 to 20 years. We love this market. One thing you'll notice, each of the markets I'm talking about are in states that have 0 state income tax. They're very business friendly. They have great population growth. They have great economic diversity in the jobs markets. So we really like these in Tennessee. We actually have a few builders that we work with in Tennessee, and they'll pay for a commitment to do a 5.25 interest rate. The rent versus price ratio is a little higher in Tennessee than in Texas. The appreciation is a little lower in Tennessee than in Texas. When we look at like average trends, right, we can go back the last 25, 30 years and look at the market trend. And again, you've noticed more appreciation in the A-class areas of Texas than in Clarksville, Tennessee. But it is a very much a growing market. You'll get some appreciation there. It's a very safe market. And the cash flow with 25 to 30% down is very decent for a single family residence. So we really like this market a lot. And Marshall Reddick manages property in each of these markets. So the property manager is Marshall Reddick. So when the property is done being sold, it gets onboarded with property management. Everything is done at the same company. And I believe Marshall Reddick manages about 400 properties in Tennessee. They manage over 1,200 properties in Texas and a little over 500 properties in Florida. They also manage between, I think, 300 to 400 properties in Southern California. So yeah, each of these markets we're talking about tonight, Marshall Reddick handles the property management. And then these are some properties we have out in Lehigh Acres. This is with a builder called Panther Builder. They build just great properties. We really love their inventory. One thing I've noticed about the Fort Myers market is, new construction, you notice some overbuilding over the last, call it 5 years. Coming out of the 2009 and 10 crisis that we had in real estate, there was so many resale properties available on the market due to short sales and foreclosures that new construction, for one, it really wasn't needed, but it's always needed when you look at the future 20 years because of population growth. So we want to see about 1 million properties a year that are being built and delivered. And after the 2009 and 10 crash, we were building about 300,000 to 400,000 homes a year, or during the, call it 11, 12, 13, 14, 15. And over time, as the unemployment rate went down, the jobs market became more sound, and as financing became more available for builders, you started to see us get back to more normal levels. We were at about 800,000 to 900,000 a year in 2019. So still not even caught up. This is why we still have a housing shortage nationwide. But I think that through the 2020, 2021 zero rate environment that we had, you did see a lot more building coming out of that. And I think some of these markets just got a little bit overbuilt. And over time, as rates come down and as the market sentiment changes, I really just believe you're going to get a lot of absorption in these markets. And it's going to really be based more on what's the job markets in the area. And that's what's going to drive future appreciation. So I've noticed personally in Lehigh and in areas of Florida, it's definitely overbuilt right now, but there's some great opportunities. There's some great bargain opportunities. This particular builder, they actually hold a lot of their own inventory. So I think they have about 150 properties that they personally own. So they're very invested in this market. We like to see that. And if you're interested in Florida, there's some great opportunities right now. The builder will do a 4 commitment buy down to a 5 1/4 on these. And these cash flow about $850 a month based off of that 5 1/4 interest rate. So the rent to price ratio is very high in Lehigh Acres. Okay, and just a little bit more about what is the buyer going to pay when they obtain the special financing, right? If the rate is 3.99 or 4 1/4 or 4.75 or 5 1/4. To determine the exact cost based on your credit, down payment, your scenario, based on the property that you're trying to buy, based on the incentives being offered by the builder. Again, we'll just have you go to reedhazard.com. We'll do a consultation. We'll get you pre-approved. And then what I want to do with every buyer always is just provide a closing cost worksheet, loan estimate before you place your offer. And that way you know exactly what it's all going to look like, and then you guys are good to go. We're noticing a lot of buyers right now that are doing 1031 exchanges. They have single family homes that are 10, 15, 20 years old, some of them a little bit older than that, and they've made good money. Maybe they bought properties too in 2006, 7, 8, 9, and 10 in markets that didn't really do a lot. But after COVID, where we had what I like to call the great spreading, right? People just spread out everywhere. You've seen a lot more appreciation in those areas. You can maybe sell that property you were underwater on or didn't really make a lot of money on, and now you can sell it, and actually you're going to get out with profit, and you can exchange that equity into a different market. New construction is great for that. When you sell a property and you do a 1031 exchange and you defer your taxes from one property to another, you have 45 days to identify that next property. So after you sell, from the day your property you're selling closes, you have 45 days to identify the property or properties that you're going to exchange into. And then you have 6 months to close on that property. And so for new construction, it's great because a lot of these properties are near completion or the next phase is almost done. We can pinpoint the lots that you want, and we can essentially help line up this 1031 exchange. We have buyers that are looking at these properties and they go, awesome, I want to buy 3. They go, they list their properties on the market, we get them pre-approved, and then they literally sell their properties. And then here at Marshall Reddick, we help them do the exchange and exchange into these new construction properties, and we're very successful at it. Just a quick story, I had a buyer, he sold a property in Burlingame. He had about $2 million to exchange. He bought 9 investment properties in 3 different markets. He bought in Tennessee, Florida, and he bought, I think, 5 properties in Texas. And we did all that at the same time. Literally, we're able to help him sell in 1031 into 9 investment properties in multiple different markets. So buyers that are self-employed, buyers that are doing 1031 exchanges, buyers that are investors, buyers that have multiple companies. We eat, sleep, and breathe that. It's what I've specialized in for my whole career. I own rental properties, so I'm passionate about it. And the team at Reddick, we're just second to none when it comes to helping the small investor, right? The person that has a net worth of, which if you have more than a $20 million net worth, hats off. But more, for people that are under that threshold, there's so few resources out there for wealth management. And I think on the real estate side, nobody does it better than Reddick. A little bit about myself. Also, I'm located here in San Clemente, California. So how do I know about Texas? So I have 300 relatives in Texas. Most of my family grew up there. I own rental property there. I love the great state of Texas. I love all the markets that we were talking about tonight. And I am a family man. I've got a 5 and an 8-year-old, live right here in San Clemente, California. So any of you guys that are located in Orange County, Reddick, we do put on live events all over Orange County, LA County. We do some events up in the Bay Area as well. We have some events coming up here over the next few months. If you want to know what those events are, go to marshareddick.com, click on the events tab, and you can actually see upcoming events right on the website. So one other great resource and tool that everybody should be reading is the Reddick Property Rating ebook. This teaches us about property classes. What's an A, what's a B, what's a C? And why do we stay away from luxury and D-class properties when we're investing? This is on the Reddick website. It's a free download. And if any of you want to get it to, you can email Cameron Carlson. All his contact information is going to be right here. And he can get you guys a copy of the ebook. He can walk you through the Reddick website. The Education and Learn tab has just got tons of data on here for any of you guys that are first-time investors or all the way to the very experienced investors. And the other thing on here that I love is the market data packets. Each property will have a market data packet based on that market. What's going on in that market? What types of jobs are in that market? What are all those economic, those different things that we look for when we're investing? Why does that market have it? And so there's economic packets on each property on the website. But yeah, there's Cameron Carlson's contact information. I'm available anytime if you guys want to talk. And yeah, it's been great talking to you guys tonight. I hope that you got a lot out of the event. We're looking forward to speaking to you guys again soon and wish everybody the most of luck. Have a great night.
Thanks, everyone. Thank you, Reed.